By 2026, the era of the standalone enterprise bank account has effectively concluded. Financial services are no longer external destinations. Instead, they operate as native features within the software businesses use to manage their daily workflows. The scale of this transition is reflected in the transaction data. In 2021, total embedded finance accounted for roughly $2.6 trillion. By 2030, the B2B segment alone is projected to reach $15.6 trillion. This growth is a response to macroeconomic pressure. Inflation and rising interest rates have forced small businesses to prioritize the acceleration of cash conversion, seeking liquidity directly within their primary operating platforms. This shift relies on a specific structural change: the decoupling of a financial institution's regulatory license from the customer-facing software interface. To understand modern global capital flows, we have to dissect the underlying banking-as-a-service, or BaaS, architecture. We will examine how its microservice design manages B2B cash flows and the regulatory conditions dictating its survival. The industry splits the user experience layer from the regulatory foundation. Embedded finance is the visible layer, integrating lending and payments within non-bank software. Banking-as-a-service is the underlying plumbing, providing the APIs necessary for account management, real-time ledgers, and mandatory KYC identity verification. In this model, the banking license is separated from the customer-facing product. This contrasts with legacy banking, where the license and the user interface were inseparable parts of the same institution. This separation changes the economics of the industry. Banking moves from a capital-intensive model requiring physical branches to a capital-light model powered by digital infrastructure. This framework allows vertical software platforms to manage complex financial flows natively, bypassing traditional incumbents. Scaling these services requires moving away from monolithic legacy core systems, where transaction processing and account management were rigidly coupled and prone to wide-scale failure. Modern BaaS platforms use a 5-tier stack. The base infrastructure layer uses Kubernetes to manage containers, scaling individual services to meet peak demand without impacting the core ledger. The persistence layer then uses polyglot persistence to maintain data integrity. It splits data based on requirements. Relational databases handle transactional data for ACID compliance, while cloud warehouses manage analytics. Above this, the messaging layer uses the ISO 20002 standard, ensuring real-time synchronization across the stack layers. Standardized messaging is the requirement for moving from traditional end-of-day batch processing to instant fund transfers. The security layer wraps the lower tiers in a defense-in-depth perimeter, using OAuth 2.0 to control access. Capping the stack is the connectivity layer, using APIs to bridge the BaaS platform and third-party software. This modular microservice design provides the resilience needed to handle millions of daily API calls. If one service encounters an error, it is isolated, preventing a systemic failure across the entire financial network. As the technical architecture has matured, embedded finance has transitioned from low-risk retail tools to high-complexity B2B applications. In the logistics sector, a disconnect between physical freight and financial systems created a $1.5 trillion trade finance gap. Supply chain platforms like Flexport address this by embedding inventory and tariff financing directly into their logistics software. Flexport provides capital by underwriting loans based on real-time shipping and customs data. This bypasses the lengthy approval cycles of traditional banks that rely on lagging financial statements. In healthcare, disjointed legacy billing systems cause administrative friction and delays in revenue collection. Platforms like UpDocs secure patient payments by embedding payment links into HIPAA-compliant scheduling workflows. HIPAA is the federal law restricting the release of medical information. By sending a secure link via text immediately after an appointment, practices collect copays before the patient leaves. By integrating payments and liquidity into specialized industry workflows, software platforms eliminate the toggle tax, the time lost switching between applications, and become the primary financial hub for their users. The rapid growth of BaaS has brought intense scrutiny from federal regulators, including the OCC and the FDIC. The primary risk involves shared liability. A licensed sponsor bank remains legally responsible for all partner compliance, including anti-money laundering workflows, even if they do not have direct control over a fintech's internal policies. This exposure means that if a software partner has weak oversight, the sponsor bank faces massive reputational damage and legal risk. Federal agencies have responded with enforcement. In 2023 and 2024, regulators issued consent orders against institutions for systemic breakdowns in Bank Secrecy Act compliance and third-party risk management. Remediation is a long, expensive process. Blue Ridge Bank required a 22-month overhaul of its risk management team before it was permitted to resume growth. The requirements for bank fintech partnerships have been recalibrated. RegTech investment and uncompromised compliance oversight are now mandatory prerequisites for market viability. The difficulty of managing both complex microservice stacks and strict federal compliance is leading to market consolidation. Providers are splitting into two models. Specialized providers offer modular tools for large enterprise platforms, while full-stack providers offer all-in-one solutions for smaller firms. Regulatory mandates are becoming unified. Europe's PSD3 and the Digital Operational Resilience Act, DORA, make uptime and fraud prevention strict legal requirements. Standardized messaging provides high-fidelity data streams for agentic AI. By 2026, these models will use the connectivity layer to initiate financial actions autonomously. With direct access to authorized API endpoints and real-time ledgers, AI agents will handle corporate treasury tasks like FX hedging and liquidity sweeping. This shifts human teams away from manual reconciliation toward strategic forecasting. As finance becomes an invisible feature of the global operating system, managing the world's capital will demand a precise balance of API scalability, vertical-specific design, and uncompromising regulatory rigor.